What is up guys, Doka here. In this video, I'm going to talk about why I only trade one strategy and why you might want to consider doing the same. And please stick to the end of the video as I'm going to reveal everything about that strategy. So when you first start to trade, you need to adjust your trading schedule to your work schedule. So for me, I'm busy working during the day. Now, a strategy that I trade on the daily time frame suits me best because all my setups will happen at the same time every time. So basically, I know I can be at work not worrying about a trade that I might miss doing my work schedule, and when I get off work, I can come in to my PC and check the chart and see if I have a setup at 5 p.m. every time. And mind you, it only takes me about 10 to 15 minutes to analyze 12 different markets. Let that sink in. 12 different markets takes me about 10 to 15 minutes to analyze. So basically, if I were to place a trade in between, I would have plenty of time to do that because the setup happens at 5 p.m. I come in, I know exactly what I'm looking for. If it happens that day, I go ahead and place my trade. So a lot of new traders sadly get this wrong as they need fast actions. So when they first start to trade, they want to immediately jump into the 5-minute charts, the 15-minute charts. The bad thing about that is that when you go down to those lower time frames, the market tends to move a bit faster, well, a lot faster than it does on the daily time frame and the 4-hourly time frame. What they should really focus on is trade the higher time frame, like the daily and the 4-hourly time frame. What this will do for them is it will allow them to analyze the market in a much slower pace, or see the market move at a much slower speed, and this will increase their ability to read the market faster. As a result, that will help them to have a much better execution. On the higher time frame, the market also tends to be more predictable. So more predictable the market is to you as a newbie, the better it is for you to execute your trades. Trading one strategy on one time frame has literally no downside, especially if you're a new trader. What this will help you to do is to build your confidence while you're doing the same thing over and over again. Now, when you only have to look at one time frame and focus on one strategy without having to worry about you missing out on other trades setups that might happen on that next pair and that next strategy that you have in your arsenal. But when you only have that one thing to focus on, you will get better a lot faster. Even though on the daily time frame and the 4-hourly time frame, the market moves a lot slower, but your speed at which you will gain experience at being a better trader. What I mean by experience is experience in executing your plans. Doing the same thing over and over will give you that extra confidence that you will need, especially as a new trader. That way you can tackle the lower time frames like the hourly time frame, even the 15 to 5-minute time frames. All right, now it's time for us to look at the market, to look for two examples. We'll take a look at a sell side and the buy side. But I must explain to you what's this whole thing that you're looking at. This software is a professional software that I use called NinjaTrader. And up here, you'll see the pair and the time frame. Right now, I'm gonna take that example or those two examples on the pound Aussie on the daily time frame. And this is the 50 EMA. As you can see here, that's the period is 50. Now, the rules of that strategy, when that entry signal is valid, that signal or that candle must open and close either below or above the 50% retracement. We've got a great example over here, First of all, we have to identify where the market is trading. On that day, the market was trading below that line, and this is that candle that represents 1 day. What we have to check is if that candle did in fact open and close below the 50% retracement. This green line is our 50% retracement. As you can see, that candle is a valid entry signal. Now, once we've identified our valid entry signal, we have to then look for how we're going to get involved. We are going to get involved in that strategy with a stop order. It's always a stop order, whether you're looking to buy or sell. And this order type is a sell stop order. A sell stop order tells your broker to put you on a short position as the market is headed downward. In this strategy, I trade this strategy at a 1-to-1 risk to reward ratio. That means if I'm risking $10, I'm looking to make $10. Pretty simple. My entry will always be 1 pip below the lowest low. So the lowest close was at 1.7767, but the lowest low was 1 pip below that. Now I must place my entry 1 pip below that. Is going to be at 177.65. My stop loss will go 5 pips above the highest high. Now the highest high was 179.23 plus 5 is 179.28. So this is where I start drawing the fib retracement, and as I go down, and when the price over here on that 50% retracement gets to that 177.65, this is where I stop. Basically, my risk, since it's a 1-to-1 risk reward, I must just clone that and then do this. It would look something like this. Now, once we've placed our order, so pretty much we'd place our sell stop order and then wait for what the market would do. And then next candle prints, we are in the trade, then stop loss goes up there and take profit limit order would go here. Same way, the order type that we would place for the stop loss would be a buy stop. That way, since we have already in the market, then we would place a buy stop order. That way, if we were to be wrong in that trade, then we can get out with a loss. And down here, we would place a buy limit. That way, we don't have to be at our PC to be able to close down that trade. We set the limit order, the buy limit order, then we leave it. That way our broker can trigger us in at that price. Next candle. Now 1, 2, 3, 4. 4 days later, our limit order, our buy limit order would get triggered with a win. In that example, this was a winning trade. Once we've got the winning trade, what we do, we look for another valid signal candle. Down here, all that we'll be looking for is to sell the market. As long as the market is trading below that line or below that 50 EMA, we're only looking to sell. This is another example. See, the market open and close below that 50% retracement. The lowest low was 175.81, and our stop will go 5 pips below the highest high. The highest high price was 176.82. Now plus 5 would be 87. So 82, 81 would put us at a 1 pip below for our entry. All that we do, we would place our order, entry would go here, stop loss would go here. This next candle would put us in the trade. Now what happens next? So this very candle would trigger us, or would trigger our buy limit order, which would put us at another win. So far, 2 examples, 2 win. I'd like to find a losing example. So market is still trading below that line. Now on that candle, the market crosses that line and closes above that 50 EMA. And what do we have? We have another example down here. Highest high was 176.26 plus 5 would put us at 31, 46, 43. Next candle would trigger us in. Now we would be in the trade. What happens next? This candle over here would put us at another winning trade. What happens next? I need to find out if this candle, if we had a lower, that was not an entry or a valid entry signal. Those two candles, okay, this candle here is a perfect example of that entry signal. But what happens next? That next candle did not put us in. Now mind you, if on that day we have placed our sell stop order and then next candle prints 5 p.m. candle close, did not put us in the trade. And you see what happens, this candle on that trading day that week went above, the market traded above the previous highest high, meaning if you're wanting to trade that strategy, of course you need to back test it. The only order you would put or you would place would be your entry order. Once you get triggered in, then you would look to place your stops in your target. Now because we did not get triggered in, well, it would be a valid entry, but it would not put us in the trade. That means on that candle we did not have a trade. But in this candle, since the market traded below that, we can consider taking an example. This candle here would put us in that trade in this example right here. Then what happens next? Hopefully that's yeah. So this is very nice as we got our first losing trade. So that was 4 examples. Out of 4 examples, we've got 1 losing trade, which is really important. That way you get to see the strategy also loses money. Now it seems like the market is only trading above the 50 MA, which is fine. Now when looking for a signal candle or a trade setup, we would not be looking for a candle that looks like this, but we would be looking for a candle that looks like this. Now when looking for a buying opportunity, the wick must be on the downside or to the downside, whichever you prefer. We've got the long way to the downside. That means during that trading day or that trading session, which was 1 day in that example, because we are using the 1 daily time frame, there was a lot of buying pressure. That's why we've got the market open at the price. The sellers pushed it all the way down here but could not hold the ground, and then the buyers pushed the price past the open price, push it even higher and close it at 5 p.m. Eastern time. So what happens here? We've got a valid signal candle. We don't know if we're gonna have an entry yet, so this is where we are looking to place our buy stop order. So when we're looking to short the market, we would be entering the trade with a sell stop order. On the flip side, we would be looking to place a buy stop order. As the market is moving up, then we can get triggered in. If we are to win, then we win. If we are to lose, we would lose. Very next candle that printed got us in the market and also got us out with a win. I believe those 5 different trading examples were enough to show you what the strategy is all about. As you can see, pretty simple. First thing, make sure you've got your chart set at the daily time frame. Second, look for where the market is currently trading at. Third, if the market is trading above the 50 EMA, make sure you have 50 EMA indicator. If the market is trading above the 50 EMA, you only looking to buy the market. Of course, that's when you get a valid entry signal, which is a candle that opens and closes above the 50% retracement. Fourth, if the market is trading below the 50 EMA, only looking to short the market, and you are trading it with a 1-to-1 risk reward ratio. The same amount that you're looking to risk it's the same amount that you are also looking to gain. And if you want to trade this strategy for yourself, make sure you back test it, because right now, as I'm recording this video, I'm also doing my back testing in that one strategy. Of course, those 12 pairs that I've mentioned earlier in the video. And that's it. That was the strategy. So if you have found this video to be helpful, please make sure to like, comment what you've learned from that video in the comment section. And if you're new to the channel, welcome, and don't forget to subscribe, as I will be sharing everything. By everything, I mean everything. I will be sharing everything about my journey. And as always, thanks for watching. I'll see you then.